We are re-entering earnings season. It's absolutely critical that you have a good game plan in place to protect yourself from all of the downside risk. I always like to think that those nice gap ups will take care of themselves. I'm really concerned about protecting myself and my capital from those big downside events. Now, if you look back just at 2024, Salesforce.com, Dow Jones component, fell 21% on a poorly received earnings announcement. Earlier in the year, there was Palo Alto Networks, one of the largest cybersecurity companies in the world, fell 29% on a poorly received earnings announcement. And if you go back just to 2022, Meta, one of the Magnificent Seven, one of the largest companies in the world, fell over 40%. If these companies at this scale, at this size, can move to this degree, there is no stock that is incapable of having a large gap down or a large gap up. So you really need a plan in place. Now, we're going to get to the process I run to protect myself and what I do and the thought process behind it. But before we do, I think it's really important that we address why these moves even happen in the first place. Because it seems really illogical on the surface. If you just take a moment and think, how can a company like Meta, with its scale, with its revenue streams and its size, how can that company be worth 40% less tomorrow than it is today? It just doesn't make sense. But if you boil it down to the numbers, and we have to play by Wall Street's game, this is the way investors operate, there is a mathematical explanation for it once you kind of go through and you understand the basis. And it's important to understand that. It's not terribly complex, but it's important to understand it because those are the rules of the game. You have to understand the rules of the game if you're going to be playing, because then you know how to react to news, and you have to understand what your upside, downside risk is and what potential outcomes can be. So it's absolutely critical. So we're going to first start off with a hypothetical example, then we're going to look at some real world case studies, and then we'll go to how I operate around earnings season. All of this is in a white paper we just released. It's a free white paper. It's available on my website with the link below. It's our fourth white paper. People love the other ones, and this one I think is the most impactful, the best one we have yet. So if you want to follow along with this example, hit that link below, and all the tables, all the numbers, the charts are all included, and it'll be very helpful for you to follow along. So we'll start off by looking at a high growth company, because these are really the ones that are most sensitive to changes of assumptions that lead to these big gap ups and gap downs. So, Wall Street's always looking at what is this company going to be worth down the line? What are we going to be 5, 10 years from now? What's going to be possible? And that really affects the price of the stock today. All of the earnings, everything that's come is old news. It's all about future expectations and assumptions. So let's look at the case of a company that's already growing strongly. Let's say it's growing at 45% a year, its earnings, and they expect that to happen for 5 more years. So $1 of earnings today will turn into $6.41 just 5 years from now. So amazing how that compounded growth can really impact earnings, and that impacts the stock price as well. So if you look at what is, this is very conservative, but a 20 PE, stocks usually will trade at 20 PE, that's $6.41 5 years from now. 20 times that is a stock price of $128 a share. That's how Wall Street analysts get to these targets. It's just through some of this modeling. Obviously, this is a very simple example we're looking at. They go into a lot of the details, but basically it's trying to map out what will earnings be into the future, and that allows them to figure out what the price should be today. So if a company's growing at 45% a year, $1 gets to $6.41 5 years from now, and if you do 20 times that earnings, the price you should expect to see on the stock is $128 a share. Now, let's pretend that a new catalyst walks into the room. For example, COVID hits and suddenly everybody's working from home. So let's say the company is Zoom Communications. Although it was already a fast-growing company before the pandemic, definitely the pandemic and the work from home really lit a fire under its business. So management comes out on earnings and says, well, I know we were expecting 45% growth per year, but because there's a higher amount of usage now, and we see this probably persisting, we expect to have 55% growth per year for the next 5 years. So we went from 45 to 55% growth, a 10% increase. But that compounded over time has a big effect. That same dollar per share, rather than growing to $6.41, will grow to $9 a share. So if we look at a 20 PE, that equates to about $180 stock. So right away there, we have a 40% increase in the stock with a small change of assumption. That's why you can see these massive gap ups, and someone on the outside will say, how can the company suddenly be worth 40% more overnight? Well, the company just forecasted they expect to grow for 55% instead of 45% over the next 5 years, that growth gets compounded and grows on itself year over year for the next 5 years, resulting in what is much higher earnings down the road. And then with that, same 20 multiple, you get a much higher stock price. But people are people. We all know the way the stock market works. When stocks are falling aggressively, people are scared, nobody wants to buy it, they sell out of fear. When stocks are going up, they buy out of excitement, and they'll pay sometimes crazy valuations. Estimates get wild, all kinds of different things happen. So of course, I think Zoom's a great example as well. As the stock starts to take off, although the management guided to 55% growth, people start to say, well, you know what? There's a lot of different ancillary businesses that Zoom can move into. There's so much more they can do even just beyond conferences. They can get more into chat. They can get more into productivity tools. Instead of 55% growth, we think Zoom can do 70% growth. And you know what? If a company is growing at 70% a year, the multiple shouldn't be 20, it should be 50. Usually you get a 50 PE with a stock growing at that kind of a rate. So now look at how this changes the situation. We go from a 55% assumed growth rate to 70, but now the multiple out of sheer excitement and enthusiasm goes from 20 to 50. So that same dollar of earnings today grows over the next 5 years, becomes $14 a share inside the model that these people are assuming. And if you multiply that by 50 now, you get an implied stock price of $714, or 300% higher than what the already higher assumed stock price was going to be at $179. So you start off at 128, you gap to 179, and now through continued excitement, you run all the way up to $714, all on these small assumption changes. And this happens all the time in the market. So there's not an immense amount of change at the company, but just these small assumptions, these small changes in assumptions over 3, 5, 10 years has a dramatic impact. So now what happens usually after we have this big advance? Competition comes into the market. Microsoft says, hey, we can offer Teams as part of the 365 productivity suite. So a lot of people who would have paid separately for Zoom say, well, I already get it with Microsoft. Why pay a separate subscription? So Zoom's growth rate starts to diminish. Management comes out at the next earnings and they say, well, I know we promised you 55%, but because of increased competition, we're only going to be able to deliver 50% compounded growth over the next 5 years. That may not seem like a big difference. We went from 55 to 50, but the problem is the market had already priced in 70% out of enthusiasm. And on top of that, you can no longer justify a 50 price to earnings multiple if the growth rate is declining. And as the stock price falls, people probably panic. Instead of a 20 PE, they just want out of this company now. They'll even sell it at a 15 PE, 15. So if we do the same math and we look at a 50% compounded growth rate, $1 grows to $7.50. If you multiply that by 15 for the newly revised lower valuation, that equals only $113 a share, or an 84% decline in the stock. We went from an original $128 assumed price to $179 on higher guidance. Through excitement, we ran up to $714, and as reality set in and a small readjustment lower in guidance, we fall all the way back down to $113. That is how the cycle takes place. On the surface, it may seem like a lot, but especially if you, I really recommend you download the white paper because it's all broken down there in the chart. It's just small changes of assumptions, which if you've been investing for a while, you can see how quickly and how dramatically that can change, how quickly and dramatically PE multiples can change. And that's what drives these big cycles. So when management comes out, and this is why often they'll even maybe beat earnings estimates for this quarter, but if they guide lower, the stock price crashes. So somebody's sitting there, I don't understand, they beat earnings, why is the stock down? They lowered their guidance. It's about guidance and that compounding growth rate over time. And to make matters worse, if you're sitting in a stock that's dropped to this degree, and let's say for this example of Zoom, that, first of all, let's bring up the chart of Zoom. If you look at the stock chart of Zoom, you can see how, I didn't use Zoom's numbers, but you can see how this tells the exact same story of what actually happened to Zoom. But someone sitting with it way down after a major decline is saying, well, this used to be such a high price stock. If we just get back up to near those highs, we'll be fine. The reality is those assumptions are not coming back. They can't justify those growth rates. There's no more excitement or enthusiasm to justify those valuations. That price is not coming back. So you're sitting in there looking at a stock price, looking at prices that you think are relevant, but they're just no longer relevant in what the reality is for the market right now. So super critical that you understand that these small changes of assumptions, specifically on guidance, are really what drive these big gap ups and down. So why are there these big gaps? If they change that growth assumption, and sometimes it could be buried into that conference call. If you're listening to, you won't really quite get it at first, but analysts will pick that up very quickly. If there's a change in margins, a change in revenue assumptions, a change in earnings assumptions, that'll be picked up immediately, and that'll really move the stock price overnight. And then typically we'll have a driving force for a number of weeks as funds slowly reposition to the new reality. So if we take a look also at some other real world case studies, just to kind of really show how this is not a one-time thing with Zoom, let's take a look at CGC, which is Canopy Growth. This was the largest marijuana company in the world at the time, I guess. There was a lot of excitement because they was going to be decriminalized in Canada. You can see, so we started off with initial reasonable growth assumptions. We got very excited as we started to climb. Then everyone was expecting America to decriminalize as well, and there was all of the hype and the excitement that led to a dramatic stock rise. Then reality came in. It wasn't going to happen. And the stock came right back down. If we go take a look at 3D Systems back in 2013, they created 3D printing, or they were one of the leaders at the time, I should say. Everyone thought this is going to change manufacturing, it's going to revolutionize the way things work, and we had this dramatic advance, these expectations. Well, if we take over this industry and that industry, think of all of the potential output. Then the reality came home that these 3D printed products don't live up to the same kind of specs as maybe regularly machined parts and all the rest, and the stock came down to reality. And if you go back, way back, let's go back to Amazon.com during the dot-com bubble. This, I mean, it was not the Amazon of today, but we started off as an online retailer. We had, a great product. They were selling books, and the idea that suddenly it'd become this marketplace for everything. We had this dramatic rise, and then as .com burst, we realized, they won't get to that, at least not right away. It's going to take much longer than we expected. Instead of having this all done by 2001, it's going to be 2015 by the time we get there. So the stock price crashes down, and then slowly over time recalibrates with what the reality is of the situation. So this is really a recurring cycle with different industries, different stocks, different times. This is just the way the market operates. And if anything, it's more dramatic now because of high frequency trading and algorithms, which just move prices in extreme ways when they can sense that people want in or out of a company. So how do we deal with this now in real time? So the situation that makes this unique is if you were just worried about the downside, you say, look, just sell the stock. But the reality is you're investing in these companies because you do see the big potential upside. I mean, even those examples that we looked at, like we spoke about Zoom, where we had an original assumption of $128, went up to over $700 a share. You want to capture that if it's possible. I mean, that's why you're invested in these growth stocks in the first place. So you don't want to just sell the stock and lose all of the upside. In fact, if you're still in the stock, you're probably expecting management to raise their guidance, not cut it. The cutting of guidance is the unfortunate surprise that we have to deal with. So simply selling the stock is not a possibility. So if you want to protect against downside and leave your upside, there's really only one option that exists, pun intended, is using options. It's the only way you can manage both. Of course, you can cut back stock to reduce risk, but then you're giving up upside. If you want all of the upside and you don't want the downside, options are the way to go. And that's what I use in my strategy now through each earnings season. Now, options, I think, can get a bad rap. Sometimes rightfully so. They can seem overly complex. There can be so many different strategies. I'm a stock trader using options. I'm not an options trader who's trading stocks. So by that I mean, I just want the very simplistic usage of options just to address the concern I have at this moment. So if you look at just the buying of options, specifically puts, it's the same as buying an insurance contract. You can think of buying a put as buying insurance, just like you would buy insurance on your car or your home. So when I'm looking at my stock, I'm looking at my position. The first question is, is it worth paying insurance for? If I don't see a lot of upside, why am I even paying insurance for this stock? I will just sell the stock and take the profit. Secondly, if I do want to sit in the stock, then I need to assess, does it make sense with the price of insurance? So now let's say you want to insure your house against flooding. It can be very inexpensive if you live inland, you're away from any kind of major water source. If you're on the Florida coast and it's hurricane season, it's going to be much more expensive or maybe impossible to actually get insurance to insure for your home. So the pricing of that insurance is important. And that's where it comes down to the volatility of the stock. If your stock is very volatile, if it's a young growth stock, it's going to be more expensive. The insurance sellers, the option sellers understand what the volatility is, and they're going to adjust that pricing accordingly. So rather than get stuck in the complexities of options pricing, I like to stand back and just look at this like a business person. If I'm in this company and I have, let's say, a 20% profit, and I still see a strong future for this company, I look at what options pricings are, and do I think I'm willing to pay that amount of money to hedge my stock? If I'm up 20%, and it's going to cost me 4% to hedge my stock, and I think there's a lot of upside for me, that's a risk I'm willing to take. Now, most growth stocks during earnings, if you buy at the money puts, so let's say the stock is at $400 a share, and you buy puts to protect yourself as of $400, so you have no downside whatsoever, usually the cost is going to be 4 to 6% of the stock. That's usually the going rate. If the stock is very volatile, you're going to pay a little bit more. If the stock is more conservative, you're going to pay a bit less, but that's the going rate. So when looking at earnings season, that's like a businessman. I walk in and I say, am I willing to pay that 4, 5, or 6%? For those wondering why there's such a big disparity of pricing potential, think of it again in terms of insurance. If you want to insure your car, the insurance company is going to look at where do you live? Is there a high chance of it being robbed? Are you driving it to work? How many kilometers do you do a year? They want to know what are the chances of you crashing this car or having this car stolen. Same thing, if you're buying this insurance for a stock, you're buying this put, they're going to look at what is the risk going into this earnings report. Are they expecting a major announcement? Is the stock just typically a crazy wild stock with only a few shares outstanding and there's wild moves? All that gets priced into the options. Honestly, as a regular investor, you don't even have to worry about that. Just look at it as whether you're willing or not to pay the price for those puts when you want to hedge that stock. It's important, but people have already made the assumptions that go into that pricing. That's the pricing you need to deal with. Now, for myself, not only is there the pricing consideration that's important, so I want to understand, is this worth my while? First of all, if I don't already have a profit on the stock, more profit than the cost of the insurance, I just sell the stock and exit. I want to be able to finance these puts with open profit, where I put myself in a position where, in a worst case scenario, I'm still making money on my trade. But I think the really important element that we have to address are the psychological impacts. If you have a 10, 20, 30% concentration in a single stock, and it surprisingly gaps down 30% against you on a bad received earnings report, that's very difficult to deal with psychologically. Not only are you working from a kind of like a very frazzled point of view when trying to figure out, should I sell the stock? Do I stay in the stock? And making a poor decision can result in much more losses or potentially missing out on a rebound. All the new opportunities that come your way, you're going to be so concerned, so shell-shocked from the loss you took that you're not going to be able to look at new opportunities with the same clarity. So not only do you lose on that big gap down, but then you lose out on a lot of opportunity cost. And it takes a lot of time and effort to rebuild your confidence and your psychological strength. So protecting against these earnings reports are important financially, but they're also very important psychologically. And so you really want to factor all of that in when deciding whether or not you want to use options or what really your game plan will be for earnings. Because getting stuck in a big gap down, or we say one, what if 3 positions gap down to that degree? It's bad luck, but bad luck happens. So for me, that's why it's just so critical. Now, this does happen in real life. You know that Palo Alto example we spoke about earlier? Well, with the membership I run, Caruso Insights, where I go through all of my process, that was a position that we had going into that earnings report. We had bought it a few months back. It was a great acting stock. We were up double-digit percentages on it. Going into that earnings report, we bought puts just ahead of that report, and when it gapped down, we didn't feel any pain. The cost of the puts were paid. That was the insurance contract. But we were able to call up the insurance company, basically the seller of those puts, and put the stock to them at a much higher price. We were able to avoid that massive gap down. And so that's so critical to be able to have a simple strategy you can apply in real time without complicating your process, that's easy to understand, and just really smoothing out your equity curve and making life simple, removing the stress, the anxiety. I've been through a lot of stressful events as a professional trader throughout my entire career. And the older I get, the more I just don't want to deal with those outlier, extreme stress situations. Even if I can withstand it financially, psychologically, I just don't want to have to sit through those situations anymore. So this is a good example of how, looking at Palo Alto, where this strategy really came in tremendously handy for that situation. So all of this and more is covered in that white paper. Again, the link is below. I highly recommend you think through what you want to do with earnings season, because it's really critical. It's not something you want to ignore or put off till later, because it's something that happens 4 times a year. It's out of our control. But if you want to stay with your stock, if you think you have big potential, long-term potential, you really need a game plan for how you're going to handle earnings, specifically if you're a little more concentrated. I hope you enjoyed this video. You can follow me at my website, carusoinsights.com. I'm on X at trader_mcaruso. We'll be back soon with some more videos. Good luck on earnings season.